Hello, this is Doug Gerlach from iClubcentral. Welcome to our monthly investment club webinar. Today is Tuesday, July 18th, 2023. Today we're going to be taking a look at rebalancing your investment club portfolio. We're going to discuss the advantages of portfolio diversification as it relates to a typical investment club, and we're going to talk about what happens if your portfolio diversification is not on track, how you can improve it, the steps you can take to improve your diversification, and that will be covered in the next 45 minutes or so. Russell Malley, our club accounting advisor, and Sean Polrang, our lead technical support rep, are in the back office. So please feel free to use the questions box at any point during the presentation to type in your question, and we'll do our best to answer them. The handout is available in PDF format in the handouts tab. It'll also be available on our YouTube channel when we archive the video replay of this webinar. So let's get started and just take a look at one of the new features that we've just introduced at myiclub.com, our club accounting operations and accounting platform. This has to do with our new feature in the report section, where members can select their favorite reports and graphs from the menu of almost 50 different reports and graphs that we show for your club accounting, record keeping, operations, and portfolio management needs. When you select a report as a favorite, it appears in the My Favorite Report section at the top of the reports page. So this is a quick and easy way to bookmark those reports that you use most frequently and put them in a place where you can access them quickly. To get started, go to any report, and at the top in the right, you'll see a star icon. If you click that star icon, it will turn gold, and that will indicate that this report has been saved as a favorite. If you wish to remove it from your list of favorites, you can click it again, and it will go back to a plain white star. And then once you have selected your favorites, they'll show up at the top of the reports page in that My Favorite Reports section. So this is specific to each user. Members might choose different favorite reports than treasurers or other officers, for instance. The one note, the reports in My Favorite Reports are appearing in the same order as they do on the main reports page. So reports that are higher up on that page will appear first. Reports that appear at the bottom of the reports page will be at the bottom of the My Favorite Reports section. There is a reset link that you can click on the reports page in the My Favorite Reports header, and that will reset to the defaults. We have a few reports that we've pre-selected as defaults for new users, and so it will the reset link will go back to those default choices. So this is just a little feature enhancement that we think will help make it a little easier to navigate as we continue to add reports and functionality to the My iClub website. So now let's turn to the topic at hand, the importance of portfolio diversification as it pertains to an investment club portfolio. Diversification is important for many reasons, primarily because the return and risk levels can be improved in your portfolio if you have diversified your holdings by company size and by sector and industry primarily. The different characteristics of companies that you own can also help your performance during economic or industry-specific downturns. The reason that we hold many stocks is that problems in one industry may not impact other industries. And during a recession, those sensitive stocks might see their performance deteriorate, but if you're holding defensive stocks, that will offset some of the downturn that you might experience from those economically sensitive holdings. So spreading out your holdings can reduce the risk that also comes from over-concentration in a few companies or industries. So when we talk about diversification by company, by sector, by industry, by company size, we have to watch out and make sure that a portfolio could be diversified and include many different industry groups. But if all those industry groups are in the technology sector, then you're going to not going to see the maximum benefits of diversification in your portfolio. And that's what we mean by over concentration, when you are focused too tightly on a narrow swath of economic industry groups and sectors in your portfolio. So here's an overview of some basic diversification recommendations as Better Investing has developed them over the years, with some of my input on some of these suggestions for your portfolio. I think that it's a great idea to have a portfolio between 20 and 30 stocks with no position less than 3% or greater than 25%. And that gives you a nice firm target. There is a lot of evidence that suggests that after you add around 20 or so stocks to a portfolio, you can no longer diversify away any more of the risk in that portfolio. In other words, the volatility in that portfolio won't decrease significantly after you have collected about 20 stocks. My rule of thumb is that no holding should be less than 3%. Ideally, it should be closer to 5 or 6% or more. And the rationale for that is that those small holdings don't do anything for your overall performance. If you hold if 1% of your portfolio is in a particular stock and that stock doubles overnight, that's a fantastic 100% gain in that particular stock in a very short period of time, but your entire portfolio will only see a 1% gain. All right, so it doesn't make sense to hold stocks at such small proportions. If you want to make commitments to your stocks, you want to have significant portions so that you can benefit from their gains as they appreciate in price. And then on the upper level, this is a figure that is considered a rough rule of thumb, no more than 25%. If 25% of your portfolio is in a single holding, that's a little too over concentrated. It happens occasionally, and you can deal with it on a case-by-case basis. Usually it happens because your selection has performed well and has grown to become an outsized portion of your portfolio. So that's a basic guideline for total portfolio construction. Better Investing suggests that you include many different sizes of companies, and they suggest an allocation strategy of holding 25% of your portfolio in small companies, 50% in mid-sized companies, and 25% in large companies. This is to maximize the benefits of capital appreciation and growth that comes from small and mid-sized stocks, with a little bit of the stability that comes from mature growth companies on the large side, and a little bit of faster growth potential from the companies on the smaller side. And you mix them all up and you have a recipe for slightly outperforming the broader market, which is our objective. It's a great idea to also diversify by sector and by industry. My suggestion is that you include all three super sectors, defensive, sensitive, and cyclical, in each between 15 and 50% of your total portfolio. There's no real guidelines for how much you want to of your portfolio you want to diversify in the different super sectors, but that's a rough guideline and you can adjust it as you see fit. You should have 8 or more sectors represented. Typically there are 11 or 12 commonly accepted sectors in the Morningstar data that we use at Better Investing and iClubcentral. In our tools there are 11 different sectors, so 8 sectors allows you to capture a broad swath of the economy. Typically, energy and utility stocks are not necessarily included because of the difficulty in identifying growth opportunities in those industries, but that still leaves you with 9 other sectors that you can find investment candidates in. And then each company should be from a different industry and not closely related to other industries that are held. And by that we mean if you own a semiconductor chip stock, don't also own a semiconductor equipment stock, because the same headwinds and tailwinds and economic factors often influence both of those different companies. So both of the companies in both of those industries. So keep that in mind and try to make sure that you're spreading out your holdings into a number of different industry groups with no overlap. This is a graph of the size diversification target according to Better Investing. The company size in the Better Investing orthodoxy is determined by revenues, trailing 12-month revenues, where a mid-sized company has revenues between 1 billion and 10 billion. Large company has revenues greater than 10 billion, and a small company has revenues less than 1 billion. We also, in my iClub, have a category called Mega for companies with revenues greater than 50 billion, and Micro for companies less than 100 million. This is often useful in screening when you want to eliminate very small companies that tend to be much more volatile, don't have a lot of history, and aren't really suitable for a high quality growth stock portfolio, and also eliminate the mega cap companies that simply don't have the earnings power, the growth, capital appreciation growth power, because they are such large businesses that you can get a much better growth profile, capital appreciation profile from smaller and mid-sized companies. Another factor to consider as you're looking at the sector diversification is the sector weighting of the S&P 500. This is from 2019. It remains relatively the same throughout time, but you can see the biggest chunk of the S&P 500 is allocated to information technology stocks or technology companies, the second largest healthcare, the third largest financials, and that's about half of the sector weighting of the S&P 500, the 500 companies in the S&P 500 index. The S&P 500 is meant to roughly approximate the contribution of each of these sectors in total to the American economy. So it could be a good plan for you to consider some of these sector weights as you developing your own particular strategy for diversifying by sector. So that's why we show this graph. You can find this on my iClub as well in the sector and industry diversification graph. There is a link at the bottom of the page to this illustration, so you can refer to it. And speaking of the My iClub diversification reports, there are several reports that you can access on My iClub that will help you in monitoring your diversification. There's the company size diversification, sector and industry diversification, earnings per share growth rate diversification, which is a way of measuring your portfolio diversification by how quickly earnings are projected to grow according to your members' stock selection guides. And then finally, one of our newest reports, the Global Diversification Report. We're not going to talk much about global diversification today. It is what we would consider a special case. Upwards of 30 to 40% or more of the S&P 500 companies' revenues and earnings come from operations outside the United States. So if you have a fairly substantial exposure to large and or mega companies in your portfolio, chances are you've got some global exposure that's already there, so you don't have to worry about finding companies outside the US in which to invest. So let's talk about building a diversified portfolio in the first place. Stock portfolio construction is something that new clubs often don't think about. They don't need to think about it. Club members can buy the best stocks they can find without worrying too much about diversification, as long as they don't double up in any particular sector or industry too much. So they can go ahead and start collecting stocks. But at some point, clubs have to shift from that mentality of collecting stocks to managing a portfolio. And that's when diversification and the concepts behind it really become much more important and can be used as a driver of focus for the club in its investment research and in its efforts to find new candidates for its portfolio. When we talk about portfolio management, we really are trying to ensure that all of the holdings in your portfolio are working towards your portfolio objectives. And one easy way to think of it is that we might hold a large dividend paying stock, not because we expect it to generate a lot of price gains for us, but because we expect it to chug along and provide some stability to the portfolio. And once we have stability, then we can add smaller company stocks that are growing more quickly, and the two of them work in tandem. They might not perform at the same time, but over the long term, they cancel out the negative aspects of each other, and the positive price appreciation and total return that they generate will help you achieve your objectives. So all in all, we want to make sure that you have the highest quality companies that you can find that have the potential to deliver returns that will help you achieve your objectives over time, and make sure that they're not working at counter purposes. So diversification considerations really become important whenever you're thinking about making changes to the portfolio. So an established club, when you sit down at your meeting and someone's presented a stock study, would be looking at how this stock fits into the current portfolios. Does it overlap? Is it too similar to another holding? Is it too closely related to the industry of another holding? Is it another large company stock when you're trying to find smaller investments? And it becomes a factor in the decision-making process. It doesn't mean that you're necessarily going to reject every company that comes along for diversification purposes. If you find a large company opportunity that you have a lot of conviction about, that you've done your research, it appears to be working fine, there's nothing wrong with taking a position in that security, but recognize that at some point you've got to pay the piper, and you're going to need to address the diversification outbalance that you've generated by selecting that stock. If it works out and that stock performs well, then all to the better. If it doesn't work out, then you're going to have to pay another type of tax on the poor results that company has generated for your portfolio. So we can take a look at some of the approaches to rebalancing that are commonly used by financial advisors, with their customers, by robo-advisors that you may have heard about, often are using similar approaches. There are ETFs and mutual funds that utilize different strategies for rebalancing over time. One common strategy that's often used for ETF or mutual fund portfolios, where you've got a portfolio of perhaps 4 or 5 different ETFs or mutual funds, perhaps in your 401k or IRA account, and every year, at the end of the year, you might adjust the holdings to bring everything back into balance according to a preset percentage target that you've set out from the get-go. Sometimes those targets may change. For instance, as you age, traditionally, in the past, the rule of thumb is that as you get older, you shift out of aggressive capital appreciation into preservation of capital and generation of income, but so much of that advice is outdated here in 2023 as people are living longer and longer. Retirement age has not gone up with lifespans, so by the time you're ready to retire at 65 or even 70, you probably will need to be have a portfolio that can generate and support you for another 20 plus years, and many people aren't going to have enough income generation to last that long, so you'll want to have still a portion of your portfolio invested to generate capital appreciation. Calendar rebalancing is about as automatic as you can get. You don't have to actively manage or monitor your portfolio once you've decided I'll do this every year or twice a year. All you do is you sell shares of whichever ETF or fund is overweighted, and you will buy shares of the ETF or mutual fund that is underweighted, and you bring everything back to that, 15, 15, 15, 10, 25, whatever percentage allocation that you've created in your plan. One of the advantages is that you are constantly selling the stocks, the securities that have performed well, and you're buying the ones that have not performed as well. So you're capturing perhaps a little bit extra value, but there are tax considerations as well, because you're selling the winners and you're buying the losers. So you've got to pay capital gains taxes in a taxable account. If it's in a non-taxable account, that's a different item. So you may have heard of calendar rebalancing. This is not something that I would suggest for a stock portfolio or for an investment club. I don't think that it's really appropriate, especially with a long-term focused portfolio where you've got a 5-year or longer window trying to hold your investments accountable even just once a year is probably not appropriate. And you're going to end up not giving your companies the opportunities to really earn out their potential over the long term. Another approach to rebalancing is known as threshold rebalancing, where you adjust your holdings whenever they fall below the target or exceed that target percentage that you set up. Again, frequently used in ETF or mutual fund portfolios. It's automatic. You don't have to do a lot of analysis or monitoring of your portfolio other than watch the percentage allocations. This does require a lot of discipline, and it requires a lot of constant monitoring. If it's not automated, then you are in the position where you've got to make tough decisions, perhaps, where your emotion gets in the way of selling the securities, the ETF or fund that is performing well on a frequent basis. You're always dumping your best performers, and that can be difficult emotionally as you address your portfolio objectives. Band rebalancing is similar, but instead of hewing to a specific target percentages, you've got a band of a few percentage points on each side, and you let things run within those bands, allow for wider swings. So this gives you the opportunity perhaps to remediate the shifts in your portfolio balance with other portfolio moves over time, but it does require more active portfolio monitoring. This is probably one of the more preferred methods these days that professionals use to keep a portfolio in balance, where you don't jump at the first sign of overweighting or underweighting according to your target percentages. You watch it, and once things start to get out of hand, then you take action. And that's known as band rebalancing. And again, what that tolerance band is that you set, you get to determine on your own how many percentage points you will allow things to get out of hand. In my, you may use a similar strategy in my 401k. I use a very simple 3 index fund strategy. It was described in a book that I co-wrote back in the 2000s called The Armchair Millionaire, where we split the portfolio into 3 ETF or index funds, one for large cap US stocks, one for small cap US stocks, and one for international stocks. And you just keep that roughly in thirds. And the way that I would handle rebalancing, in my case, I choose not to use band or threshold rebalancing, but more tactical rebalancing, which is to say periodically, if things are between 25 and 35, I let them run, and then periodically will adjust my new 401k contributions so that the underweighted portion gets more of the new purchases and the overweighted portions get less of the new money that's flowing into it. And so in that way, I'm able to take advantage of the longer term secular trends that might affect large caps, small caps, international caps, international stocks with respect to each other. And over time, the strategy can actually deliver better results than simply investing in an S&P 500 index fund by itself, according to what we discovered when we wrote the book back in 2000. So I call this that strategy more of a tactical rebalancing. This is rebalancing where we're not selling simply because of diversification reasons. We're taking action to improve diversification by considering what we're going to buy next. What are the next portfolio moves that we're going to make? And I think this fits with an investment club. This is a pretty sound strategy that you can use in your club portfolio. So if you've identified a situation where you're out of balance, where you have not enough small company stocks, then you set a target of increasing your small company stock exposure. If you own too much technology, you're going to take aim at finding stocks that offset that technology exposure, and you're going to pay attention to those overweighted technology stocks and perhaps look at them with a more severe eye towards evaluating their performance. And at the first sign of trouble, you might pare down some of that position. And then as new money flows into the investment club, which is a great tool that clubs have, the inflow of new member deposits, you can make those adjustments that over time will help the portfolio move closer to targets. If you're investing on your own and you've got a portfolio that you're not funding on a regular basis, it's much more difficult. It can be much more difficult to rebalance without selling shares or replacing companies in the portfolio. But in a club where you've got money coming in on a regular basis, you have the opportunity to be tactical, to take advantage of opportunities, and to improve your diversification over time. Now, one thing to keep in mind as you approach diversification is avoiding diversification. This is a term coined by Peter Lynch in the 1990s. It refers to adding securities to a portfolio in a way that worsens the diversification. So if you have a lot of technology stocks, maybe adding more doesn't help your diversification. It makes it worse. It diversifies your portfolio. Likewise, holding securities with similar characteristics, or what we call correlation. So if you own CVS and Walgreens, or if you own both Lowe's and Home Depot, or Home Depot and Tractor Supply, you are not getting the full benefits of holding two different securities from a diversification standpoint. Certainly, CVS and Lowe's, of the two of these, one of those companies has performed much better in recent years, but, and there will be different factors that impact both of the companies separately. Walgreens has a European business, and so that is going to have different factors impacting its business than CVS, which is purely domestic. But CVS owns a mail order pharmacy, so that's and a health insurance company, so that's going to impact their business differently. But any trend that impacts, any economic trend that impacts negatively or positively the operation of drugstores is going to impact both of those companies to some degree. So holding both of them is really not recommended. Another problem would be holding securities with overlapping holdings. For instance, if you owned a total stock market ETF like the Wilshire 5000, these are the 5,000 biggest companies on the stock exchange in the US stock exchanges, which is pretty much the bulk of the publicly traded universe by market cap in the US, and you own the S&P 500, the 500 companies chosen by Standard & Poor's to represent American business. Uh, yes, there are 4,500 more companies in the total market ETF, but their performance over time tends to track very closely. So you're not getting diversification elements by holding both of them. And there are reasons why you might choose one over the other, but holding both of them is not giving you any diversification elements in any appreciable way. Something that people don't think about is if you own an S&P 500 ETF and you own a stock like Apple, well, you're doubling up on your Apple holding, because Apple makes up about 7.5% of the S&P 500. So you might have more exposure to Apple simply by holding an S&P 500 ETF or index fund than you might consider. So do you need that much Apple in your portfolio? That's something that you should consider. Holding more than 30 individual stocks is also what I would consider diversification. We have seen, or Russell, in talking earlier today, Russell mentioned that he's seen clubs that have held more than 90 stocks, or even one that had 120 different companies. I think that sound you heard was some of the treasurers on this presentation shuddering at the thought of trying to manage a portfolio and tax returns with 90 or 120 different stocks. And the fact of the matter is that those portfolio performance are not likely to perform any better than an index fund. And those members of the clubs would just be far better off investing in a single ETF. If you didn't want to invest in an S&P 500 ETF, you could invest in an S&P 100 ETF or another managed or indexed ETF of broad market cap stocks. And that would get you much of that same performance. So there's really no big benefit. The reason that mutual funds and ETFs that are managed hold more than 30 stocks in most cases, there are some that have as few as that, is that there are rules about diversification that they have to follow, so they can't be overly concentrated in any single holding. And they also, as a matter of size, once a mutual fund starts to get bigger, it has to buy more companies. It has to buy bigger companies. And so it loses the effect of concentration that can drive outperformance. When years ago, we published a mutual fund newsletter for a few years, and one of the biggest learnings of that was that the best performing funds that we would find, the most consistent performing funds over a number of years, often had 50 or fewer companies. Because those managers had a highly tuned strategy, they could concentrate on fewer holdings, and thus they could outperform broader market indexes. Whereas if you're a large mega cap mutual fund, all you're holding is the biggest brand names, and it's hard to gain an edge when you're investing that way. So watch out for these problems in your club portfolio. Just a few thoughts on meeting your targets. Don't get frustrated if you set targets but can't find opportunities. It's probably because the market's saying that the sector that you're looking for right now is in favor and thus is expensive. So for instance, right now, you may have heard the news for the last 2 years telling us that a recession is on its way, and that inflation is out of control, the Fed doesn't know what it's doing, and so a lot of investors have turned defensive, which means they've bought stocks that typically perform well during economic downturns. Those defensive stocks, however, are now selling at a premium. Why? Because of the fears of recession, and investors want to be more defensive. Like with homeowners insurance, you might not think about it until you need it, and then at that point it's either too late or it's very expensive. Now, when defensive stocks are expensive, what are cheap? Well, cyclical stocks are really cheap right now. When you look at home building stocks, often they have single-digit PEs. That's the market saying that these stocks are likely to not perform well in the next, in the foreseeable future, and so they're selling at bargain basement valuations. So what's that tell us as long-term investors? If we're looking beyond the economic cycles, maybe it's telling us that cyclical stocks might be providing opportunities right now for a buy and hold portfolio. And then at some point down the road, we can up the defensive portion of our portfolio when those stocks retreat a little bit in price. Over the long term, you have plenty of opportunities. So you don't worry about meeting your targets in 6 months or even in a year. It's something that you will constantly strive towards, but it is definitely achievable. So let me talk about some rebalancing in action, some scenarios, and the necessity of having an action plan. I think it's very good for clubs to have specific goals. Set your portfolio diversification goals. Use the basic recommendations in this presentation as a starting point. Adjust them as you see fit, as it meets your particular objectives. But set those clear targets. Have the discussion in your club. Determine what they're going to be and how you're going to work towards them, so that everyone understands it and is working towards the same goal. And it all starts with knowing your current diversification levels. You can't fix it if you don't know where the problems are. So evaluate, look at the performance reports on my iClub, the diversification reports on my iClub, so that you can understand them. Here are the graphs, which I think are more useful than the reports. On the left is the report by industry. The green, the blue, and the black represent the super sectors, and the industries that are in there are sectors as well, but these are the industries of each of the holdings in this particular portfolio. The green, the light green on the left represents the sensitive super sector. These are the industries that during an economic downturn are going to be impacted, but not as significantly as the cyclical super sector, which is the light blue. The cyclical super sector stocks are the ones that really will take a hit during a recession. When you look at this, you can see, for instance, specialty retail industry is in the cyclical section, along with industrial real estate investment trusts, and restaurants, and residential construction companies and auto parts. And the rationale here is that during a recession, people are not making big purchases at specialty retail stores or luxury goods, for instance. They're worried about their jobs. They're not buying cars. Companies are worried. They're not buying heavy machinery, construction equipment, making capital outlays. So industries and sectors that serve those types of businesses tend to see their operations slow down during a recession. The cyclical, or the sensitive side on the light green, see an impact from recessions, but it's not as severe. And so you'll see here rental and leasing services, consumer electronics, electronic components, semiconductors, application software, et cetera. So they'll may see a downtick in their businesses, but they will are not what we would consider traditional cyclical companies. And then the black pie slice at the bottom is the defensive super sector. That includes healthcare stocks, utility stocks, and consumer defensive businesses like grocery stores and drugstores. These companies tend to not see any side effects from a recession. Why? Grocery stores perform well during recessions because people continue to shop for food, and oftentimes discount stores and drug stores see upticks during recessions as people down market. Instead of eating out as much as at restaurants, they're staying at home, so they're buying more of their food from grocery stores. And so that's why, for instance, and medical stocks tend to perform well during recessions because in the United States, by and large, most people don't pay directly for healthcare. They're paying through insurance companies, and those insurance plans continue to pay. So a lot of non-elective procedures continue during recessionary periods, and so healthcare stocks often will perform well during periods of economic downturns. So in this portfolio, the defensive sector, super sector is, a little bit light, but that's for you to decide. You can see some big chunks in the specialty retail and consumer electronics industry, some big holdings there that you can pinpoint by looking at the portfolio graph. On the right side is the company size diversification graph. So you can see the individual companies that fit that make up this particular company portfolio of companies. The purple is the mega-sized companies, the very largest companies. The light blue is large, the orange is mid-sized, the green is small, and the light blue, the very light blue, turquoisey color is the micro sized companies. So this portfolio has companies of all sizes, but it doesn't come close to matching the better investing guidelines. There's too few small companies and too many mega and large companies and not enough mid-sized companies in this portfolio to be appropriately diversified. And again, you can see the impact of some of the big chunks of stock, Apple, at the top, O'Reilly Automotive at the bottom, simply pointing out that there are some big holdings within those mega and large categories. So there's a lot of interpretation and study and learning to be made from looking at your club's portfolio diversification using those graphs. So let's talk about scenario number one, where you own too many large companies. This is not uncommon in an investment club. Many investors and clubs gravitate towards the brands you know, the products you use, the stores you shop at. So as a result, investors are buying, have confidence in those high-profile brand name, large or mega company stocks. I don't think I need to name them. You know who they are. And the problem is that you become overloaded in those large holdings, and that's going to actually drag your growth down because those are not going to be the fastest growing or highest total return candidates in your investing strategy. If you're satisfied with them, there's no reason that you have to sell them, but one approach to take is to make sure that new money that's coming in and new purchases are made in small and mid-sized company stocks, and pay attention to those larger holdings to take advantage to sell on fundamental weakness or hypervaluation. Hypervaluation is when a stock is beyond overvalued. It's in a range of valuation where the downside becomes so enormous that to not lighten up on holdings would be imprudent in your portfolio management practices. Scenario number two, if you own too few sectors, again, my target is to aim for 8 out of 11 sectors. Don't worry about utilities and energy unless you have some specific knowledge or you want to build a core portfolio with some mature growth businesses that aren't going to generate a lot of capital appreciation but may provide some dividend income. It's my opinion that most clubs don't need to worry too much about dividends. You should probably be let the individual members invest in dividends in their personal portfolios and keep the club portfolio focused on capital appreciation as the primary form of return. If you have too few sectors owned, you can find the sectors that you don't own on the My iClub sector industry diversification report or graph at the bottom, it will list the sectors that are not owned. And so that gives you the opportunity to direct research into those areas. You can assign members to tackle and identify companies in those sectors that you might want to consider. Stock screeners are great for those particular types of searches, where you can say, show me companies in the basic materials, industrials sectors, communication services, and we'll look for those companies first. And a tip, if you have different attributes that you're trying to fill in your portfolio, such as companies of smaller or mid-sized, you can combine those to do double duty in searches. So it's no point if you're overloaded on technology stocks to find a great small company that's in the technology sector. It might help with your company size diversification, but it's not helping with your overweight in technology. So you can combine those in a thoughtful way. It can help you find better candidates. Scenario number 3, you've got a single stock that is highly overweighted. This is often caused by a stock that you've held for years. It's made big moves. It's now sitting at the top of your portfolio as the single largest holding. And there's resistance to selling even some of the holding because of the capital gains that would be incurred. And the double-edged sword is that the better this stock performs, the more resistance there is to selling because the capital gains burden would be much higher. In a club, you can definitely use strategies such as paying off at least part of a full member withdrawal by transferring shares of that highly appreciated stock. The capital gains then get deferred for the remaining members, and you're improving the portfolio as well. If you have a stock, another point that you can consider when you've got an overweighted single stock is if you've got a stock that you're selling at a capital loss, you can sell a little bit of the overweighted holding at a capital gain, and the gain and sell enough so that the gain and the loss offset. So there's a net gain loss of 0 from the sell of the two securities, and thus lighten up a little bit of that overweighted holding. Scenario number 4, if you've got an overweighted single stock and you don't have the opportunity to sell or replace it, then you can use the new money coming into the club to offset that single holding. So the problem with this approach is that it can take a very, very, very long time to see the position decrease significantly. But you can think in terms of opposites when researching replacement candidates. So if you've got a mega cap technology stock in that overweight number 1 position where it's 25 or 30% of your portfolio, then seek out small company defensive stocks, for instance. That would be, something that would have much different correlation and characteristics than that single overweighted stock. You do that enough over time, and that percentage may start to decline and be in a much better position. If you have questions, please use the questions box. Russell and Sean are in the back office and have addressed many of the questions. I think I've addressed some of the questions that have come in. Pat asks, is the 25, 50, 25 size allocation still holding these days when large stocks have returns similar to mid-cap stocks? It's as with many things in the market, they tend to move in cycles, long-term cycles, and so just because the last few years we've seen large company stocks and mid-sized stocks performing about the same doesn't mean that's going to continue forever. And there's also a continuum. The smaller mid-sized companies are going to perform more closely aligned with small company performance. There's always a question about what is large, what is small, what is mid-sized. Are these definitions appropriate? There are always discussions that are going on in monitoring that's going on. So again, there's a reason we call them guidelines. They're not hard and fast rules, and you can certainly modify them. But the upshot of it, the key takeaway is that if you're investing solely in large and mega company stocks, you're missing out on a lot of return potential that comes from investing in smaller and mid-sized companies. And the organization believes that, and I believe it as well. So I would say it's about sticking to those classifications and those determinations when you're looking at your portfolio. Jimmy asks about the size diversification criteria that we use at my iClub, where we have the mega cap and the mega and micro company definitions, slightly different than Better Investing. Otherwise, the large, small, and mid-sized definitions are exactly the same as Better Investing. We just carve out that subset on the smallest of the small side and the largest of the large side because we believe that it provides a little more insight into your holdings. Simply calling Apple a large company doesn't do it justice, right? Microsoft, Amazon, Apple, Meta. I mean, these are enormous businesses, and if you want to have the Nifty 7 or whatever they're calling them these days in your portfolio, you can certainly do it. But you know, that is not always going to be the most optimal way to generate long-term capital gains in a stock portfolio. And the NASDAQ 100 index is rebalancing because of the outsized impact of the seven biggest holdings. Seven biggest holdings make up something like 50% of the index. So that's not very diversified. So I'm sticking with the definitions again as a guideline, as a tool for you to start thinking about the attributes of the companies in your portfolio. So a few final thoughts. Portfolio management is an ongoing task. It's never ended. And if you reach the target and you're very close, you're within a couple of percentage points of your selected targets in all ways, you know, that will likely last until your next club meeting when one of your stocks is going to make a big price move up or down and everything is going to be, you know, all the percentages are going to be adjusted once more. If you're successful in investing in small and mid-sized companies, they're going to become mid-sized and large companies. So most clubs and individual investors need to spend more time looking for smaller company opportunities, not only because those smaller company opportunities are the ones that tend to work out not as frequently as mid-sized and large companies, but the payoff when they do work out offsets that additional risk. But it also means that you need to constantly be identifying smaller companies for your portfolio. And to reemphasize, we've provided some guidelines, but don't sweat the details. And as you're building out your portfolio, especially if you're a newer club, it's not as critical. And you're not going to be every stock that you buy is going to have a big impact on your diversification. Don't worry about it being out of balance until you've got, you know, close to that 20 stock target. But ignore diversification at your peril. Tech stocks back in the 1990s were performing so well. The economy was in full expansion mode. The internet had arrived and was just transforming so many different businesses and industries, and a lot of investors thought they could just buy any tech stock and ride it up. And then when the boom ended, it came down with a crash, and a lot of investors realized at the time that diversification was a valid strategy for helping manage the risk in their portfolio. So don't make that same mistake again. Those type of balloons can happen at any point in the market cycle. So trying to maintain a common sense approach to diversification will really benefit you during down markets and provide that consolation that you need when things get tough. So this is a little bit of real world evidence. Better Investing has established couple of years ago an investment committee to invest a portion of the organization's cash reserves according to Better Investing's principles. So the board of directors said, well, we're sitting on cash, but shouldn't we be investing some of that cash according to what we're teaching members? And so they established a Better Investing or a committee chaired by the chairman of the Better Investing board, the CEO of Better Investing, some staff, and board members, of which I am one. And this is the current company size diversification of the holdings, and there's practically no cash. It's all fully invested, and so the mega and large combined is about between 25 and 30%. The small is between 20 and 25%, and the mid-sized holdings a little bit more than 50, between 50 and 55%. That to me is a perfect allocation according to the principles. You can see that no company, the outer ring shows you the individual companies, so that you can see that no individual company is excessively large or excessively small. None is smaller than 3% of the total portfolio value. None is much more than 10 or 15% at the largest. So the organization definitely practicing what it preaches in terms of company size diversification, and here is the diversification by super sector and by sector. So again, the defensive stocks are the lightest. That's because some of the sensitive and cyclical stocks have performed better than perhaps expected. So they've shrunk down that defensive sector. And also the defensive sector, it's been harder to find opportunities in the last couple of years as the committee was building up its portfolio. So you can see a high exposure to technology stocks on the sensitive side, and to the consumer cyclical sector on the cyclical side. But all in all, well within the strategies that the organization has talked about, that I've talked about today. So I think those are some real world examples of utilizing these principles. There are 9 sectors represented here. So all sectors other than energy and utilities are represented in the portfolio. So in the eyes of the committee members, there have been stocks in all of the different sectors that meet the minimum goals for being held in the portfolio. So let me end with just some discussion of some of the tools that we offer at iClubcentral that I've mentioned. We have 2 stock research and analysis websites, Stock Central, which has an easy-to-use stock screener that will allow you to screen by sector and by industry, and My Stock Prospector, which has 120 different criteria that really allows you to drill down into the sectors and industries, growth rates, quality metrics, and find stock candidates. Both of these are subscription tools. My Stock Prospector does have short-term subscriptions that are available. We also publish the Investor Advisory Service and the Small Cap Informer newsletters. We're very proud of our Investor Advisory Service newsletter, which is 50 years old this year. It's a multi-market cap newsletter in which it recommends small, mid, and large company stocks. Its performance is so strong that it has been named to the Holbert Investment Newsletter Honor Roll for the last 13 years in a row. It was the #1 stock newsletter of all the Honor Roll newsletters in 2021 and 2022, and it was the #1 performing newsletter in all of 2021 as tracked by Holbert. The Small Cap Informer is focused on smaller company stocks, provides recommendations each month, and tracks a universe of around 45 to 50 stocks with updated buy and sell recommendations each month, and it also regularly outperforms the market as measured by the S&P Small Cap 600. Here's the IS track record over the last 3, 5, 10, 15, and 20 years. The lifetime since 1995 is also better than the S&P 500 and the Wilshire 5000. So the green is the IS, and you know, those in some of those periods it doesn't look like a big gain, but over time those incremental improvements over the broader market mean that the stocks can really help you outperform the market. On the small cap informer, our comparison of returns of the stocks recommended to the S&P small cap 600 year to date been very strong, buoyed by the recovery of small cap stocks, which has really just started, has really bumped up the small cap informer picks, but also the lifetime more than 3 times the return of the small cap 600 index, 1 year, 5 year, 10 year also outperforming handily. So we're very pleased with the performance of those newsletters. If you're interested in subscribing and you're not already, go to the websites and use the promo code DougSteele to save on a subscription with a special low offer price. And then finally, I wanted to wrap it up. After a hiatus, partly driven by the pandemic and partly driven by other considerations, I'll be back at the Money Show in Orlando, Florida this October 29th, 30th, and 31st. I'll be presenting a workshop on maximizing dividend yield in a high quality stock portfolio. And I'll also be sitting on a best stock picks panel with a few other experts picking the best stocks for 2024 and beyond. This is a free event. These workshops are free if you are in Orlando. You can go to moneyshow.com to register or to find out more. They often have streaming classes and workshops that you can sign up for, and often they are archived on their YouTube channel. So if you are in Central Florida, rather, in October, I invite you to stop by at the Money Show. With that, thank you so much for turning up for our presentation. We'll look forward to seeing you next month at our next Investment Club workshop. We've got the schedule published on iClub.com for all of our webinars through February of 2024. We are working already on the club tax printers for 2023, in touch with many of the states, and so we'll be updating you as we go with all of the features and functionality that you can expect and the changes to tax code, etc., as we end the year. I wish you all the best. Stay cool, stay dry, stay in highland if you're in the northeast of the country. Stay cool if you're in the West Coast and the south central part of the country, and we'll see you next month at our next Investment Club webinar.